Alright guys, by now you might be noticing a little bit of a theme. I often do these videos when I'm traveling from one place to another, sometimes in batches. But anyway, here's the next video for Life Insurance Awareness Month. This one's going to be a short, quick one, so if you don't got much time, this is the one for you. And this is the answer to the question, what types of life insurance are there anyway? For many people, they don't even know where to start. And that might be you. You might be thinking, life insurance, what even is it, and what are the types? So very quickly, I want to just go through what's out there in the marketplace. So on one side of the spectrum, you have term life insurance, one of the simplest and easy to understand. Term life insurance, its main job is providing death benefit. If a primary income earner in the family or in the business, or a primary leader in the business passes away, it pays a tax-free death benefit to the beneficiaries for them to use for whatever they need. Income replacement, pay off the mortgage, pay off debt or business debt, whatever it might be, buy out partners. But term life insurance is very simple. You pay a premium, and it's usually guaranteed for a specific term, a period of time. Most common term life insurance policies are 20 or 30 years in length. But you can get them for annual renewable term. It can be 5 years, 10 years. And the premium's guaranteed for the time, the death benefit's guaranteed for the time, and it pays out if it's needed. And it often has one living benefit, terminal illness rider, which I talk about in another video. So that's term life insurance. It's a protection against the death of a main income earner, a main breadwinner in the family or the business that is invaluable and generally far more affordable than most people think. It's relatively inexpensive. As long as you're healthy and you qualify, it's pretty cheap. It's a great tool. So that's term life insurance. And then on the other side of the spectrum, you have permanent life insurance. And permanent life insurance comes in a few flavors. Permanent life insurance, as the name kind of suggests, it's typically there designed to be permanent, meaning your whole life. It will pay. And if it's done right, it's typically considered an asset, as opposed to term life, which is an expense on your ledger. It's a bill you're paying, and it's sort of like an unrealized asset. Until something bad happens, it doesn't do anything for you. Permanent life insurance, however, it will pay. It'll either pay you or it'll pay your heirs and beneficiaries, but one way or another, it's going to pay somebody. It will be in force if you maintain it properly till the day you die. And so there's a few kinds really quickly. You've got whole life, which is the most commonly used term, I think, when talking about permanent life insurance, but it's actually a type of permanent life insurance. Whole life refers to the kind of permanent life insurance that is more structured and guaranteed. It has a guaranteed premium, a guaranteed death benefit component, and a guaranteed cash value. So the permanent life insurance side, the other thing it does, the term doesn't do, is it builds what's called cash value. It has this cash account in it that grows along with the death benefit, and ultimately you can tap into it, you can use it, you can withdraw it, you can borrow against it, and it has a whole host of other uses. And whole life is the most structured and guaranteed, where it'll pay interest and dividends and a guaranteed minimum growth of cash value over its time. And there's a lot of ways to structure whole life where it can be very flexible and have a wide range of funding options. And then you've got universal life. And universal life has a couple versions. You've got regular universal life, you've got guaranteed universal life, or GUL as it's called. You've got indexed universal life, or IUL as it's called. You've got variable universal life. So there's quite a few versions of universal life. Universal life tends to be a bit more flexible inherently in how you can pay the premiums. You can often pay less in initial premium for a universal life policy for the same death benefit that whole life would do. And there's reasons for that we don't have time to get into today. But universal life will allow you to sort of underfund it or overfund it, to grow the cash more aggressively or less aggressively, to try and lock in basically on the cheapest possible permanent death benefit, and even link it to the market, like an indexed universal life, where you can link it to market gains, rise when the market rises, like the S&P 500. You might have an opportunity to earn 9, 10, 12% in an indexed universal life policy on your cash growth. And if the market crashes, you lose nothing because it has a guaranteed floor of 0 or 1%, where it will never lose, but it will only gain. And then there's variable universal life, which actually invests in the market directly. You actually have direct risk exposure to the stock market, and so you can lose and gain value in a variable universal life policy. And there's reasons why that may or may not make sense. So there's your spectrum. You've got term life, you've got permanent life, and in permanent life you've got whole life and universal life. That comes in the variety of options, and there's different uses for the different products, and as long as they're designed right for the right purpose, they can all be good in their own way for certain reasons and uses. All right, so there's your array of life insurance. And I hope that helps clear things up for you.